Hello, today is July 21st, 2021, and thank you for joining me for another edition of the Market Commentator podcast. My name is Jake Willms, and I am a quantitative analyst here at the Milwaukee Company. And as usual, joining me this morning is Andy Willms, the president and CEO of the Milwaukee Company, and also my father. So welcome back to the podcast.
Well, thank you, Jake. Glad to be here as always.
Today, Andy and I will be discussing when the U.S. economy's red-hot recovery from COVID-19 pandemic might begin to cool off, and what that might mean for the stock and bond markets. But as usual, before we get started, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are Andy and my personal views, and not necessarily those of the Milwaukee Company. And also don't forget to leave a like, subscribe, and leave a comment down below for while you're listening. If you have any questions or have any comments, we'd love to read them. But with that out of the way, let's get started. Andy, it seems that the U.S. economy was firing on all cylinders during the first and second quarters of the year.
Indeed, it was, Jake. In quarter two, the economy continued its remarkable recovery from the depths of the pandemic-induced recession. The unemployment rate fell from a high of 14.8% in April of 2020 to 5.8% in the second quarter. And America's gross domestic product, or more popularly referred to as GDP, grew at an annual rate of 6.4% in the first quarter of 2021 and an estimated 7 to 10% in quarter two. Those final first estimates will really come out from the government on July 29th. But it's important, even though that sounds terrific. It is important to keep in mind that those numbers come off a very low base. They're year-over-year numbers. And if we just look back a year, GDP fell by 3.5% in 2020. So, but overall, I think it's looking very positive. The U.S. GDP is expected to grow by more than 6.5% in 2021 and by more than 4% in 2022, both of which are significantly higher than the 2 to 3% range we've seen since 2014.
That definitely all sounds very encouraging. But with that said, I would say that I've heard several commentators say that the economic growth has peaked. What do you think about that? Do you agree?
Yeah, for the most part, I do. I think GDP growth likely hit a high point in the second quarter, and now we've moved into a more moderate phase of expansion. I expect GDP growth to slow as the boost that our economy has received from all the fiscal stimulus and all the reopenings slow. But I also think as time marches on, we'll move away from the very low base numbers that we saw on the height of the pandemic to months where the recovery began. And so you'll see year-over-year numbers being a somewhat more difficult comparison. But all that being said, I expect the economy to continue to grow solidly over the coming years. The labor market continues its expansion, and we see continued fiscal support. And in my opinion, there's virtually no risk of a new recession taking hold in the immediate future. And I point out, too, that another positive for the economy is that Americans certainly have plenty of money to spend. U.S. household wealth soared to a record $136.9 trillion at the end of March, according to a June report from the Federal Reserve. So there's a lot of, while I do think we've reached the peak of growth, there's a lot of things that could still continue continued growth for the rest of this year and probably well into next year.
So what do you think would be the biggest threat at the moment as you see it? I don't know, there's a lot of things that could derail the growth that we're having and the positive momentum, but which one would you say is the most concerning to you?
Well, I think you make a great point, Jake. There are always threats looming out there, and that could, as you say, derail the economy. Right now, I believe the biggest threat is inflation, and more specifically, that inflation will cause the Fed to raise rates more quickly than we're expecting in an effort to keep inflation from spiraling out of control. We've seen the consumer price index, CPI, increase by almost 1% in June on a seasonally adjusted basis after rising 0.6% in May. That's the largest 1 month change since June of 2008, when the index rose by 1%. And it's not just last month. Over the last 12 months, CPI has increased by 5.4% before any adjustments, which constitutes the largest 12-month increase since August of 2008. And the Fed's preferred way of looking at inflation is core prices, which exclude food and energy, and they were up 4.5% from a year earlier, for the biggest gain since November 1991. So we are seeing inflation at a much higher rate. There's a lot of reasons for that. And, of course, the Fed's been saying that inflation increases will be transitory, and there are a lot of good arguments for that point of view. But nonetheless, it could be that the Fed will be wrong, in which case, it would be a major threat to the economic growth we're currently experiencing.
Would you say it's true that this inflation threat is only a threat if the higher prices lead to a slowdown in spending? I think it's, I would say one of the counter arguments to that would be that even if prices are rising, with all of the money that Americans have, as you pointed out earlier, if they're still spending at the same rate or even more, then we probably wouldn't feel that negative.
Well, I think consumers will continue to spend as long as they believe, that inflation is transitory, and remain confident in the economy. And that seems to be the case right now. I mean, there was a report recently on consumer confidence in June, and from the Conference Board, and it indicated that confidence grew from a reading of 120 to a reading of 127.3, which was well ahead of market expectations. And the Conference Board, had an interesting statement in the report, which I'd like to share with our listeners. That statement said, while short-term inflation's expectations increased, this had little impact on consumer confidence or purchasing intentions. In fact, the proportion of consumers planning to purchase homes, automobiles, and major appliances all rose, a sign that consumer spending will continue to support economic growth in the short term.
So, what do you think about the pandemic? I think that's another part that's been kind of muted as of late. There's been a lot of talks about this Delta variant, and I've even seen rumblings of mask mandates from California. And I'm just kind of wondering if in your eyes you see the pandemic as a threat to the economy at this stage.
It certainly could be. It certainly is. I mean, I should say, because as you know, Jake, rates have last month rose in all 50 states, and we've seen the sharpest increases occurring in the states with the lowest vaccination rates. I mean, that's no big surprise. And the situation is worse overseas, where vaccination rates are lagging those of the United States in most cases. We've heard, in the United Kingdom, they're opening up again, even though they've had a really severe fourth wave as a result of the Delta variant. And we could see a fourth wave here in the U.S. as a result. So I do think the pandemic continues to pose a serious threat to many parts of both the U.S. and international economies.
If the economy does cool off, though, how do you think it will impact the stock market specifically? I know I led on to that at the beginning, so I'm kind of curious your thoughts on that isolated portion of the economy.
About the stock market itself, well, I have a cautiously positive outlook for stocks this year because I expect corporate earnings to remain strong for the rest of the year. And we know that corporate earnings is the greatest driver of stock prices. Now, that having been said, if the Fed does feel that it needs to raise rates sooner than it's been expecting to because it needs to, rein in inflation, that's the Fed's primary tool, right, is raising rates when inflation gets out of control. If that happens, then, of course, we'll see an increase in corporate borrowing costs, which would in turn lower earnings, and that would be a big drag on stock prices. And we also see that wages are starting to increase, which overall I think is a very good thing, especially on the bottom end of the pay scale. But, as wages go up, that also can be a hit to the bottom line for many businesses. And then there's also these kind of situation where you have inflation and tax rates that pose additional threats to the otherwise positive outlook for stock. There's been considerable talk about raising taxes, especially capital gain taxes. And, that would be hard on the market too. So that's why I say I'm cautiously optimistic that the stock market will continue to do relatively well for the rest of this year. But I do expect more volatility, and I don't think this is going to be a straight ride up. I do think somewhere along the way we'll see a pullback. But then again, nobody should change what they're doing based on my prediction or anybody else's in the short term, because short-term predictions are notorious for being wrong. We need to keep our focus on the long term.
Yeah, of course. But what about your expectations for the bond market? Would they be different?
Yeah, I'd say they're different. The overriding concern with bonds has been that the peak growth has in fact been reached, and that the benefits from fiscal policy are starting to fade. And we've seen signs of that. The Treasury market has been signaling slower growth by trimming yields in the recent weeks, and to the point now where, after adjusting for inflation, investors in 10-year treasuries are now being paid a negative 3.4% real return, which is the lowest real rate of return since 1980. And, I may be wrong, but I just don't think that's sustainable. And, the recent decline in bond yields appears to be driven in part too by the Fed's continuing buying of bonds at a very rapid clip in an effort to keep rates artificially low. And I don't think the Fed's buying of bonds is sustainable either. So if you ask me, it's probably not a matter of if, but when rates will start to begin rising, which of course is a negative for bond prices.
That's interesting about the Treasury market, but as we both know, that's only part of it. What about the corporate bond scene? How does that compare?
Well, I think that's particularly worrisome to me because, we've seen a rally in corporate debt on below investment grade corporate debt has pushed their yields on junk bonds to around 4%, while consumer prices rose by 5% in May. Now, that's the first time on record that junk bond yields have dropped below the rate of inflation. And we've seen, these corporations aren't dumb, if they can borrow money so cheaply that they've been doing a lot of borrowing. High debt issuance has totaled almost $300 billion in 2021, and that's a 51% jump from the same point in 2020, which was also a record year. So U.S. companies now face the highest levels of debt on record, which total more than $10.5 trillion. Now, one could argue that, there's strong balance sheets, a positive economic outlook, and the lack of competition because everything else is paying such low yields that the historic low rates being paid on corporate debt, and particularly junk debt, is justified. But for me, I just don't think a 4% return is worth it with the level of risk that's associated with buying low-rated corporate debt at this time. But then again, as baseball great Yogi Berra famously said, it's tough to make predictions, especially about the future.
All right. I like all those points you made about the bond market, very insightful, but I think we're going to have to wrap it up here. We've covered just about everything we wanted to talk about, so I think that's great. Thank you for answering all those questions.
Glad to do so.
Please keep in mind that you should conduct your own independent research before acting on any information or opinions expressed during this podcast. And you should not act on anything you have heard in this podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. And with that, I'll say thanks again to our listeners and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.